We now turn to equity. Like debt, equity represents the other major source of funds, and equity is a source of funds via preferred stock issuances, common stock issuances, of course, net of any share repurchases that we've alluded to in the past, which we call treasury stock. But then the other big source of funds that's an equity source of funds is retained earnings. And that's the concept that we've been talking about throughout this course. And that is whatever the company is earning through its operations is also increasing the value of the company, in addition to just adding equity through cash infusions. So we see these four equity line items that we've already identified in the past. Specifically, we have common stock, which is capital that's received by the company when it issues common stock. Then we have retained earnings, which is the accumulation of all the earnings that the company's generated since its inception. By the way, as a fine point, less any dividends that it's already distributed, because if you already distribute your earnings, you don't get to keep them. It shouldn't grow your equity. Now we have treasury stock, which represents common stock that's been issued and then reacquired or bought back by the company. And last but not least, preferred stock, which represents any capital that's been received by the company from preferred shareholders. And preferred shareholders usually request special rights, and they take priority over common stock when it comes to the issuances of dividends and things of that nature. So let's talk about preferred stock first. When companies raise capital, especially at early stages, investors often prefer to contribute capital in the form of preferred stock instead of common stock. So preferred stock is a class of stock that takes priority over common stock and has special rights, such as priority over dividends and claims on assets, priority claims on assets, in a bankruptcy over common stock. They don't have claims on lenders, but they have priority claims over common shareholders. Preferred stock is often structured to include the possibility of conversion into common stock at some preset exchange rates, which enables investors, preferred investors, to benefit from a set dividend, but participate in the upside if the company's common equity value increases. Next, we turn to common stock and additional paid-in capital. Aside from debt, the primary way that companies can raise money for growth and acquisitions and whatever it is that they want to do is through the issuance of common stock. Because of an old convention, though, the accounting for common stock actually involves splitting the value of a share of common stock into two components: common stock par value, which represents some arbitrary nominal value to an issued share, like a penny per share or 10 cents per share, and anything that the company is able to raise per share in addition to that is considered additional paid-in capital, or APIC. So for example, when Google went public, it received $85 for each share that it offered. So cash went up by $85 and common equity went up by $85. But common equity actually went up. There were two line items that went up. Each share had a par value of 1 penny. And so the journal entries for one share issuance for Google stock was that cash went up, cash was debited by 85, but the corresponding entry were two equity items. Two equity items were credited. One was this nominal par value of a penny, and then everything in excess of that was additional paid-in capital. From an analytical standpoint, it's actually irrelevant. You just need to look at common stock and APIC together. It's an old convention that forces balance sheets to basically identify the two separate line items. But as analysts, we don't care. We just know that cash goes up when the equity is issued, and the corresponding equity is common stock and APIC. One thing to keep in mind that's a source of confusion for folks that are new to accounting is that once Google went public at $85 a share, many of you may remember or may know that Google shares kept going up after that. Google shares are now well in excess of $1,000 per share. Google can never write up the value of its common equity from the original $85 that it received when it issued the stock. And that is the historical cost principle. Just like you can't write up the value of assets or the value of intangible assets or fixed assets or whatever, you can't write up the value of your own equity. You have to keep the value of your own equity at the historical value that you received when you issued the stock. And the result of that is that common stock on the balance sheet of most companies grossly understates the true market value of their equity. Next, we turn to treasury stock. Shares that were once issued but now have subsequently been repurchased by the company are called treasury stock. Companies repurchase stock for reasons including boosting EPS. And you can think about the reason why that boosts EPS is because repurchasing shares, if you recall from our income statement discussion, reduces the total shares outstanding. We define the total shares outstanding as all the shares that have ever been issued minus all the shares that have ever been repurchased. So if you repurchase shares, you are going to lower your share count, which would of course boost your EPS because it doesn't affect your net income. The other reason that companies repurchase shares is to change the company's capital structure. Perhaps the company is determined that they want to be more levered. One way to be more levered as a percentage of total debt to equity is to reduce the amount of equity that exists. When a company repurchases shares, it either goes into the open market and buys them at the current share price or through negotiations with specific shareholders. The treasury stock is a contra equity account, much like accumulated depreciation is a contra asset account. Treasury stock is a contra equity account that captures the value of common stock that was once issued but has since been repurchased. And so below we lay out the journal entries for Colgate using $1 billion to buy back 20 million shares at $50 a share. What you see is that cash goes down, cash is credited, and the corresponding impact is that treasury stock, which is a negative equity account, becomes more negative. In other words, the equity goes down, becomes more negative, and cash goes down as well. And of course, we've already just talked about this. The treasury stock impact on the share count is that basic shares outstanding are reduced when the company repurchases shares because basic shares outstanding equal total shares issued less shares repurchased. An interesting thing to observe for companies engaged in a lot of treasury stock repurchases is that treasury stock is sometimes an even larger amount on the balance sheet than the common stock and APIC balance itself. So some of you may be wondering, how could the value of the shares that the company has repurchased be greater than the value of all of the company's outstanding shares? And the answer gets back to the fact that common stock and APIC cannot be written up. So let's go through a simple example to clarify this. Imagine that Google goes public and issues 100 million shares at $85 a share. Prior to going public, the book value of the common stock and APIC was $1.5 billion. Now, 5 years later, Google shares are trading at a much higher $1,500 per share. They've climbed almost 20-fold. Google decides to buy back 20 million shares. What is the balance of common stock and APIC and treasury stock respectively? Now give this a shot yourself, hit the pause button, try to fill in the blanks, and then hit unpause and we'll go through this together. The one thing that I would say before you dive in is up till now, we've been talking about not identifying balances in our exercises, but we wanted to see sort of the incremental impact to certain balance sheet items. Here we're asking for something different. We want to understand what is the balance of common stock and APIC on the day before the share repurchase, and what is the balance of treasury stock on the day before the repurchase. We've actually given you, there's no treasury stock repurchases prior to this initial repurchase. What we want to know is what is the balance of common stock and APIC before the share repurchase, and then we want you to fill out what is the balance sheet, what is the balance of common stock and APIC after the share repurchase, the day right after the share repurchase. What will be the balance of common stock and APIC, and what will be the balance of treasury stock? So at this point, hit the pause button and give it a shot. When ready, hit unpause and we'll go through it together. So the answer is the day before the share repurchase, common stock and APIC was $10 billion. That's comprised of the $8.5 billion in common stock and APIC value from the post-IPO common stock, as well as the $1.5 billion worth of equity value that existed before the IPO. So we just add those two together and we have common stock and APIC. A balance of $10 billion the day right before the share repurchases. Now, the day after the share repurchases, nothing happens to common stock and APIC. Even though we've bought back shares, the only impact on the equity side of the balance sheet is the creation of this negative contra account. We end up spending $30 billion, or Google ends up spending $30 billion to buy back 20 million shares at $1,500 a pop. Cash, which we haven't shown in this exercise, we didn't need you to fill out cash, but cash would go down by $30 billion, and the corresponding entry will be a $30 billion reduction to equity expressed via the treasury stock account. And so if you take a snapshot the day after the share repurchase, what you see is the treasury stock now is actually bigger, more negative than the total value of all of the common stock in APIC that the company's ever issued. And that's because of historical cost, because the value ascribed to the treasury stock repurchases is the $1,500 per share, whereas the common stock in APIC is ascribing a value to those same shares at historical cost of only $85. And you actually see this exact phenomenon with Procter & Gamble. We've identified here in the balance sheet, the Procter & Gamble balance sheet, where they have the exact same situation. Treasury stock, as you see on the balance sheet, is negative $72 billion, whereas the value of common stock in APIC, here's that par value. Recall we talked about common stock in APIC being presented as two line items, really for no reason other than an old convention. And we see that the value is only $67 billion if you add it all up together. We now turn to retained earnings. Retained earnings represent cumulative earnings net of dividends over a company's entire existence. We spent a lot of time talking about retained earnings and how it really represents the plug of the income statement within the balance sheet. The income statement is connected to the balance sheet through retained earnings. All income on the income statement increases retained earnings. This should be obvious by now. And all expenses on the income statement decrease retained earnings in the form of debits. One other element of retained earnings, where retained earnings captures all the cumulative net income that the company's ever generated. We've spent a lot of time talking about that. But it's also reduced by any distributions of that net income to shareholders. Specifically, dividends need to be reduced from retained earnings. So we need to recognize that retained earnings goes up by all the future net income that the company generates, or all the net income that the company has ever generated, and it goes down by all the dividends that the company has ever issued. Conceptually, retained earnings represents the cumulative earnings that have been retained by the business after taking into account all the dividends that have been made. So similarly, some of the other balance sheet line items that we've talked about, it's helpful here to think about what makes retained earnings go up during the year. Well, if you start with a certain amount of retained earnings at the beginning of the year, which of course now we know represent all of the past net incomes all together, all added up, minus all of the dividends that have ever been issued. That's the retained earnings at the beginning of the year. And then you add to that the current year net income that was generated during the year, minus the dividends during this year, and that's your retained earnings at the end of the year. And the next year you do the same thing. Whatever net income you generated will grow this end of year balance, and whatever dividends you distributed will reduce this end of year balance.
Okay, now that we've talked about retained earnings, I want to talk about a line item on the balance sheet called Other Comprehensive Income. It's basically a very similar line on the balance sheet to retained earnings, and it's actually far less known and less understood. So let's just go over it really quickly. So other comprehensive income, it's sometimes called other comprehensive loss if there's a loss instead of income. It's an equity line item on the balance sheet that captures all of the income or losses that a company has recognized over time that's not recognized directly on the income statement. So if you think about retained earnings as the accumulation of income or loss that a company has recognized over time on the income statement, less all the accumulated dividends, this recognizes a different kind of income or loss. It has to do with income and losses from things like foreign currency translations, unrealized gains and losses unavailable for sale of securities. Gains and losses effectively that don't flow through, that don't hit the income statement. So whereas the income statement captures gains and losses effectively from revenues, less expenses, all the kind of items we talked about when we went through the income statement, OCI is sort of an offshoot. It's where under US GAAP and IFRS, there is a different the gains and losses they're not operational enough to sort of get into the income statement is the way to think about it. So an example is a company reports net income of $5 million. And in addition, the company also reported foreign currency gain of $3 million. Again, assume both are all cash. And so while the net income, because it's comprised of operating revenue, less operating expenses, taxes, interest expense, the kinds of things we know go through the income statement, that hits retained earnings, right? So $5 million of that hits retained earnings, but the $3 million in income that came from the fact that they had some benefits because they operated in foreign countries and they had a currency gain when they translated it over and brought it back to the U.S. or wherever they are, that $3 million gain isn't operate. It doesn't get to qualify under under GAAP accounting as net income, profits and or losses. So there's a separate accumulated bucket for that called other comprehensive income. So you see the debit is the 8 million in cumulative cash. The credit are these two accumulated buckets for gains and losses, retained earnings, and OCI. In terms of the presentation on the balance sheet, you see it typically, if it's significant, you'll typically see it explicitly identified on the balance sheet. It's usually far less significant than, say, things like retained earnings, because these gains and losses from translations and derivatives and foreign currency conversions, they're not usually that significant, and they tend to be very difficult to forecast as well because they're all over the place. They are things that are not tied to core operations. And so notice the year-over-year change from 2012, September 29th, 2012 for Apple, and September 20th, 2013. The change is it went from an accumulated lifetime, gain to this loss of 471 million, which means that during this period, there was a huge net loss of $970 million relative to the overall sort of accumulated bucket. And you see that $970 million loss in the statement of comprehensive income. This is a fifth statement that you'll see on financial statements that basically starts with net income. It's a statement you don't actually spend too much time thinking about, just because from a forecasting and analytical perspective, it's very hard to predict what's going to happen with these kinds of non-operational movements. You see the examples for Apple. It's things like unrealized gains and losses on marketable securities and gains and losses on derivative instruments. But you see that the statement starts with net income of, say, 37 billion was for Apple, and then there had all these changes due to gains and losses that didn't hit net income. They weren't on the income statement. If you add up all of these changes, you get to 970, a loss of 970, and if you subtract 970 from 37 billion, you get to 36 billion and change. And so this is the OCI financial statement, which is new. Several years ago, companies weren't mandated to show this fifth financial statement, but now they are. And so you see total comprehensive income via this reconciliation. So while the balance sheet represents the accumulated gains and losses of OCI, a full breakout of those are reported in a separate financial statement called the Statement of Comprehensive Income.